Hi, good evening and welcome. I'm Ginger Garvey and I'm the senior partner with Freedom Financial Partners LLC. And I'm here tonight with the fourth lesson of our basic U.S. income tax video series. Tonight we're going to be discussing the W-2, the W-4, and line 7 income on the 1040. The basic video series that we're working with now is the first class handled filing information, exemptions, and dependents and filing status. That's available on our YouTube channel. This is class 2. We're working with income. There will be 2 lessons. The first one's going to really focus on wages, salaries, do a cursory discussion with tips. Tip income is discussed in the intermediate video series. We'll also be talking about how taxes are withheld. So that's what we're going to be focusing on tonight. Key objectives for tonight is to be able to know the difference between taxable and non-taxable income, to understand the different types of employee compensation, and to understand how the W-2 reports employee compensation. We'll also briefly touch on tip income, as well as working through completing a W-4 to have your withholdings appropriately handled. So the first piece is understanding that taxable income comes in 2 forms, earned and unearned. We're going to be focusing on the earned income tonight. That's going to be wages and other employee compensation. We'll be focusing on the unearned in lesson 5. Non-taxable income. The following income is not taxed as either earned or unearned. That would include child support, federal tax refunds, interest on municipal bonds, any public assistance payments, workers' compensation, most life insurance proceeds. Portions of Social Security benefits are not taxed. The other portions are taxed. Veterans' disability benefits, and gifts and inheritance. These are non-taxable income sources. The most common types of income are wages and salaries. This would be the most common types of earned income, would be wages and salaries, tips that are received from customer, and other compensation in the form of cash, services, and property. This is what a sample W-2 looks like, as well as the highlighting of line 7 on the 1040. So line 7 on page 1 is where the primary line for income will be on the U.S. tax return. A few facts about the W-2. First of all, employers are supposed to provide them to their employees by January 31st. Box 1 of the Form W-2 reports your total wages, tips, and other compensation. That box 1 will be added to line 7. If you have multiple W-2s, we would simply add up the amount in box 1 across all of the W-2s, and that amount would appear on line 7 of the 1040. Some of the W-2 boxes provide information about the box 1 amount, and this information would not be entered directly onto the 1040. If the box 1 information is incorrect, you need to go back to your employer and request them to provide a corrected W-2, which is actually Form W-2C. If you have more than one W-2, as we were stating a minute ago, you would simply add up the amounts for box 1 for each and then enter the total on line 7. Now, even if you do not receive a Form W-2 from your employer, you still must report your income. Statutory employees are employees that are considered employees based on statute. They may receive 1099s and in fact be independent contractors, but there will be certain requirements related to being a statutory employee that will go into play specifically in the area of the reporting of income for the purposes of withholdings for FICA and Social Security. Here are some of the sources of income that would be included as compensation on line 7. Any regular pay, any advance commissions, back pay awards, bonuses and awards, sick pay, holiday gifts, severance pay, business expense reimbursements, supplemental insurance benefits, supplemental unemployment benefits, disability income, and employer-provided vehicles. So you can receive this information in box 1 on your W-2, in fact. I've seen just about all of these show up in the box 1 number. That box 1 number would have various components into that number. So here we have the initial question or example. Here we have Tony Parker, and his salary for 2014 was $36,000. Tony's take-home pay was $28,378.50 because his employer withheld Social Security, Medicare, and federal income taxes of $7,621.50. So the question is, which amount will be reported in box 1? Box 1 is going to be reflective of the $36,000. So you are taxed on the full $36,000, even though $7,621.50 was actually paid out in taxes. And that just simply says that it was the $36,000. Kenya was employed by the ACE Insurance Company. Her salary was $28,000. She was given a Christmas bonus of $1,500, and she won the sales contest in November. The prize was a 4-day vacation to Florida. The value of the vacation prize, cost of the airline tickets and the hotels, was $1,200. She did not actually take the vacation until February of 2015. What is the total compensation that her employer should report in box 1 of Form W-2? So it's going to be the $28,000 plus the $1,500 plus the $1,200 for a total of $30,700. Now I'm going to speak about tip income, and this is what we're going to say in this particular course. There is an in-depth course that's going to go into the specifics of tip income. All cash and non-cash tips that are received from customers are taxable income, and they must be reported on line 7 of Form 1040. You should report to your employer cash, check, or credit card slips that are more than $20 for any month for any one job. So if you have a position where you do receive tips, if your tip total is more than $20 in any given month, you are supposed to provide that information to your employer. Your employer should then be keeping track of that, and that number would appear along with the rest of your compensation in box 1. In the event that you had a month or two where the tip total is less than $20, you would not be required to report that to your employer, but you would still be required to add that into the line 7 amount on your 1040. Other income that can appear on line 7, the taxable portion of scholarships or fellowships, moving expense reimbursements, dependent care benefits, employer-provided adoption benefits. In most instances, you would see this amount in box 1 of the W-2. And all of this type of income would be reported on line 7 of the 1040. There is sometimes non-taxable employee compensation, and this can come in 2 varieties: tax-free and tax-deferred fringe benefits. In the event that you receive tax-deferred benefits, this could include your employer's contribution to a retirement plan. It can also include your contribution to a retirement plan under a qualified deferred compensation plan. And there's a few specifics related to your contributions to a qualified compensation plan. First, there is a limit. The limit is going to be $17,500 in 2014. Contributions to the deferred compensation is shown in box 12, and you would see a code letter D. So if you're looking at your W-2 and you notice that there's a number with a code letter D, that net amount is reflective of the contributions that you made out of your income into a tax-deferred plan. The next thing is Social Security and Medicare taxes are collected on this deferred compensation in the year that you receive it. So you would actually be paying Social Security and Medicaid on the amount of money that you put into these qualified accounts. Social Security and Medicare wages are shown on box 3 and box 5 of the Form W-2, and we will see an example here in just a moment. Non-taxable employee compensation. In the case of retirement plans, the retirement plan distributions are actually taxed in the year that you withdraw them from your retirement plan. So it is taxable in employee compensation. It's just not taxable in the year that you earned it. It's taxable in the year that you receive it. So in the case of those retirement plans, those deferred compensation plans, we're actually putting money away, and in it as a benefit to encourage people to put that money away, the IRS will not tax you on that money this year. They'll tax you on it when you take it out of that account. This is what your W-2 looks like, and you can see here this individual is reporting in box 12 with a code D a total of $1,400. So that $1,400 is Sam's contribution to his plan. When you're working with income taxes, you're generally expected to pay in at least 90% of your expected tax liability during the year. Employees must meet this obligation by having taxes withheld from their pay. Taxes may also be withheld from other types of income. Each type of income and tax withheld is reported to you and to the IRS on a different form. For some types of withholding, the withholding rate is set by law. The total amount of federal income tax withheld would be reported on line 64 of the Form 1040, and it's included in your total payment line on line 74. Mandatory withholding usually happens when we're talking about wages. Your employer would base the withholdings on the amount that you earn and the information that you provide to them on a Form W-4. The Form W-4 includes 3 types of information. First, what is your filing status, whether you're single or married? Second, how many withholding allowances can you have? And holding allowances, you can count holding allowances by the number of dependents that you're going to be claiming. You can actually increase your holding allowance if you have a known quantity of mortgage interest, for example, where your itemized deductions are going to be over a certain amount. You can actually put additional allowances in to be claimed, and that would reduce the amount of withholdings. The higher the allowances, the lower the amount that is actually pulled out of your check. And the reverse is also true. The lower your allowances, the more money that they take out. So I usually recommend for people who are with a standard deduction and moderate income that they go ahead and withhold with 0 allowances to ensure that as other elements of income come into the picture, you're not actually owing additional taxes. And then you actually have an opportunity to have additional amount withheld. So in the event that you are both an employee as well as independently employed, and you know that you are going to have to pay in for the portion of your income that's related to self-employment, I encourage people to go ahead and use the W-4 and their regular standard paycheck to have those withholdings go into their tax account throughout the year. Here we're going to look at an example just to give you an idea of what can happen when these W-4s are not updated and things get out of balance. In this instance, Dick and his wife were divorced in January. Since then, their 2 children have lived with his ex-wife, and she'll claim them as her dependents. Dick did not change his Form W-4 to account for his loss of 3 additional exemptions and his change in filing status. His employer continued to withhold his taxes as if Rick were still married with 4 allowances. The total tax that was withheld and paid was $7,533. In 2014, Rick's AGI was $62,749. Because of his loss of 3 exemptions and his change in filing status, his taxable income is $52,000. $52,000 is related to the standard deduction and the single exemption for himself. If he had been married and his wife had had no income, his taxable income would have been $34,549, which would have been equal to the standard deduction and the exemptions times the number of individuals in the household. In this case, it would have been 4. His tax would be $9,000 instead of $4,271. Because he's only paid in $7,533, he will still owe $1,467. And because he's paid in less than 90% of what he owes, he may actually be subjected to a penalty. And so he's going to owe $1,467 instead of receiving a refund of $3,262 if he was actually still married. So if you have an individual who comes in and their tax situation has completely changed, you can see how this W-4 can play a key role. The W-4 is available and can be downloaded off of the website and adjusted accordingly. This is what the W-4 looks like, and it's used for changes to filing status to change the number of exemptions. And as I mentioned before, the fewer exemptions, the more taxes that are withheld. And you do not need to fill out the worksheet portion. You can go right into the bottom half of the W-4 and complete it with the information that is necessary for you to have proper withholdings. So in review, we've talked about all taxable compensation that's earned as an employee is entered on line 7. This taxable employee compensation includes payment, whether it's bonuses, awards, could be strike benefits, severance pay, in addition to your salaries and your wages. In general, the amount listed on line 7 is the amount from box 1 of your W-2s, and if you have additional W-2s, you simply add them together and put the sum in box 1. If you have tip income that was not reported to your employer, you would need to add that amount into line 7. Other income that must be reported on line 7 would include any scholarships, fellowships, household employee income not reported on a W-2, and non-excludable portions of certain fringe benefits, such as dependent care benefits. So we'll go through the dependent care benefits in a little bit more detail later, but this is the type of number that would actually be included in line 1. Usually your information about line 1 can be found in boxes 12 and boxes 14. In the case of deferred compensation, this is the part of the pay that's received by an employee that's contributed to what we call a qualified account. This can be an IRA, it can be a 401k, it could be one of the government accounts. I don't know everybody's special numbers. And while this income is not subject to the tax when it's contributed to the account, it will be taxed when the money is withdrawn. Again, you are expected to pay at least 90% of your tax liability during the year, and this would be paid through withholdings. Withholdings is one way that the income tax is paid as it comes due. The payer withholds the tax payments from your income and sends these directly to the IRS. And this is the most common type of withholding. The amount of your pay and the information that you provide on your W-4 determine the amount of tax your employer withholds. Withholdings from your pay is mandatory. You generally do not have the option of having no taxes withheld from your pay. You can choose to have another income tax withheld from other types of income, such as unemployment compensation and Social Security benefits. If you do not have enough tax to pay your tax liability, you'd have to pay the difference with your tax return. If the tax withheld is more than your tax liability, then you would receive a refund. So again, if you've paid into the account throughout the year at a rate that is higher than what is required, you will receive a refund. In the event that you did not pay into the system as it was required throughout the course of the year, you would actually owe taxes at the time that you file your tax return, or at least the tax that you owe will be due no later than the last day of the filing period, which is typically April 15th. The information that's in this course is based on the IRS Publication 17. And again, if you have any questions or there's anything that we can help you out with, please feel free to send an email via the website or to comment on the YouTube channel. If there's anything that we can do to help you, please let us know. Thank you.